Good afternoon, everybody. Welcome to another ShareSoc webinar. Today, we shall be meeting Stephen Cooklin, who's the Chief Executive of Manolete Partners, and we'll be hearing a presentation from him, followed by some Q&A. My name's Mike Dennis. I'm one of ShareSoc's directors. I'm your host for the evening, and we should be taking you through a short introduction, and then I shall be introducing you to Stephen Cooklin. Just before we get going, one quick poll to take while you're all piling into the webinar. Could you answer the following question just so we can get a good feel for how many of you are already holders of Manolete and how many are here because you're interested? Okay, a couple more votes coming in. I think you almost all voted. There's a couple of you still to vote. I'll just leave you a second. Okay, thank you for that. Results are 55% of you are already holders of Manolete, and obviously 45% of you are of interest are interested in Manolete. So thank you for sharing that with us. Now, just before we kick off, the usual boilerplate. I'm sure many of you already know this, but we are not authorized to give you all individual investment advice. So this presentation today is for information purposes only. You can all make your own minds up about whether or not Manolete is the right investment for you, bearing in mind your own situations and your portfolios and risk profiles, etc. And a reminder, or maybe an introduction for those who've never been to a ShareSoc webinar before. We are a not-for-profit membership organisation, so we're here because we exist solely because we address the needs of the private investor in the UK market. We have over 7,000 members now, and it's growing quite rapidly. We're run by a bunch of unpaid directors like myself who feel passionate about investing in general and wish to provide you with the kind of support that we believe individual investors deserve. And a lot of our time is spent on campaigning. You may not see a lot of that going on, but in the background, it's happening all the time, responding to government consultations, discussions with regulators and so on, campaigns against companies that might be treating you badly and so on and so forth. So a hell of a lot of work goes in behind the scenes on your behalf, and you just see the tip of the iceberg sometimes with launches of campaigns like the Woodford one that we've recently started in the hope that we can help you get some of your money back if you invested in Woodford funds a couple of years ago, and many others to boot. You can see more information on our website. And then, of course, lots of information and education opportunities, of which today's webinar is one example. And we want to give you, as members and private investors, the same kind of opportunities and access to issuers of shares that the professional investors get. And that's the whole point of having these analyst-style webinars. And we hope you find them very useful, and they do seem to be growing in popularity. So we think we're on the right track. Next slide, please. Now, in terms of the technology today, it's the usual Zoom technology. And if you want to ask a question, you have to type it in, click on the Q&A box at the bottom of your screen, type away, and we'll get through as many of those as we can with Stephen after he's done his presentation. We are also using the technology to vote on the questions. So you will be able to see, as a delegate, all the questions that the other delegates type in. It helps me quite a lot if there's a lot of questions for you to vote on them so that I can see which ones you really want us to ask first. And I'll do my very best to get through all of the most popular questions before we get to the end of the 1 hour. I also have some that I've received before the show, and I'll go through those as well and mingle those in with the ones that we get during the webinar itself. So do type away as soon as a question occurs to you. One particular thing I just wanted to say while we were on the line, I've had a look at the pack that Stephen has produced today, and I'm very conscious that there's a lot of debate on in the chat rooms about Manolete at the moment due to recent events and so on. And so I'm very conscious that probably there's quite a lot of very useful, I think, information in the pack, and it may take a bit longer than your average presentation. So don't be surprised if we overrun by 10 or 15 minutes this evening. And Stephen's agreed that he's got the time to spend with us. So just thought I'd give you a warning beforehand about that. And just a reminder, we've already sent you a Stockopedia report in the reminder email. And there is also a link to that in the chat box as well if you can't find your email. And there will be a copy of the presentation pack posted on the website after the event, along with a recording in due course as well. And don't forget to provide feedback. It's extremely useful. We appreciate it, the presenting companies do too. And you should have received a link to that feedback system in an email. You'll find a link also in the chat box, and you will also, when you close your Zoom system after the presentation, you should see the feedback form appear there as well. So, Stephen, welcome this evening. I'm glad you could join us. Plenty going on in the world of Manolete at the moment, and so I'm particularly looking forward to hearing more on how things are going. And at this stage, happy to hand over to you, and I'll pick you up at the end and host the Q&A session shortly. So,
brilliant. Can you hear me okay, Mike?
I can, loud and clear.
Lovely, thanks very much indeed for the intro, Mike, that's brilliant. I'm going to try and share my screen, so bear with me, everyone. And then 5. Right, it says here I'm screen sharing, so hopefully that's working. So yes, good evening, everyone. Thank you very much indeed for your time. I'm just trying to minimize that. So yeah, I'm Stephen Cooklin, Chartered Accountant, CEO, and indeed founder of Manolete Partners PLC. Absolute pleasure to present to ShareSoc today. I think it's a fantastic platform. I feel actually very passionately about how important it is for institutional investors to have the same level of information as private investors, which is why we've done quite a few of these on other forums in the past. So I hope you find it useful. As Mike said, it's a fairly in-depth presentation. I'm going to really take you into the world of insolvency in the UK and Manolete to hopefully answer a lot of questions that I've seen over the years since we've been a public company. And I hope it's helpful. And as I said to Mike, I'm very happy to stay as long as needed for questions today. So thinking about presenting to ShareSoc, I thought that kind of put Manolete in context. I think in the world of kind of blue chip multinationals, a metaphor in the art world, you might be dealing with the great masters, your Monet, the bridge over the water lilies. In a sporting metaphor, the blue chips are Pelé and Jairzinho and Revelinho's beautiful game from the Brazilian team. And if music's your thing, it's probably the saccharine smiles of ABBA, money, money, money. Wouldn't it be funny in a rich man's world? In our world of insolvency, the images are somewhat darker, I would suggest. So I've chosen Francis Bacon here, as in Tate Britain. So this is the 3 figures at the base of the crucifix. We've got for football, we've got Billy Bremner, my boyhood hero, having a fight with Dave Mackay. You can almost see Billy Bremner saying to Dave Mackay, look, just play your director's loan account back, Dave, and Manolete will go away. And in music terms, rather than ABBA, I think you've got the genius of Malcolm McLaren and Johnny Rotten and the Sex Pistols. And of course, their mantra was cash for chaos, which when you look at insolvency investment, there is a lot of cash in amongst the very challenging world of insolvency. I remember reading back in the 90s that of all the companies and millions of companies that ever register at Companies House, by far the biggest exit route for companies is insolvency. It's not listing on a public market, it's not being sold to Unilever or a private equity fund, it's going bust. It's a very key aspect of corporate life for directors of SMEs and also big companies as well. But as you can see, with the IRRs on the right-hand side, which we've tried to slice and dice in every which way possible, the IRRs really are unseen in the financial world at this level. We'll drill into them a little bit later, but this is on a cash basis. And as you can see, the consistency over a 12-year period, or at least 10-year period, ignoring the first couple of years when we were first just testing the model, very consistently delivering these returns across hundreds of cases. So, drilling into Manolete, our business model was established in the last financial crisis, and I say last because I suspect there's going to be another one pretty soon. In 2008, 2009, I was brought in to the idea by two very clever QCs, Michael Crystal and Gabriel Moss at South Square, the leading insolvency barristers set, and they said someone needed to set up a company like this because there were thousands of insolvency cases that never saw the light of day. And so there was a need for a kind of smart investor that could get access to justice for the creditors of these companies. So for a couple of years, as I mentioned earlier, we were just very gently testing the model. I was still running a corporate finance boutique at the time. We did literally 3 tiny little cases. But we incorporated the business in 2011, and then we listed it in December 2018. Probably worth, because this kind of ends up with my final slide and investment thesis, probably worth remembering in 2018, the last quarter was very, very difficult to get IPOs away. I'd say particularly in our sector, because Vanin, a company probably more like Burford than Manolete, had to withdraw its IPO. You'll remember that Funding Circle had listed and performed poorly, and Aston Martin the same. So the fact we managed to get the IPO away at all was something of an achievement. Manolete focuses purely on UK insolvency and insolvency-related litigation investment. One of the great attractions of the model, as explained to me back in 2008 by Crystal and Moss, was that you could buy most of these claims. It was a law change that we pushed through in 2015, the Small Business Enterprise and Employment Act, where we could buy not only the bust companies claims, we could also buy the insolvency practitioners claims as well. So there's only a small rump now of what we can't buy. And by buying the cases, of course, Manolete is in control. They are our assets, they're our claims. So if we want to make an offer to the defendant on the other side, we can. If they make an offer that we like, we can take it, and that's the end of it. If we don't like the way it's going, we can just drop it. Whereas you'll find a lot of the pure funders have signed funding commitments. So even if things have turned rather sour, they're committed to still fund. So we can protect the downside very, very well indeed. When we are funding, so that minority of cases that's getting smaller and smaller every year, we are always and only funding a professional, highly regulated and licensed insolvency practitioner, and usually on multiple occasions. So unlike funding someone who's lost their job at an investment bank who might have a big claim, or a divorcee that might have a big claim, people that aren't regulated and professional and maybe somewhat emotionally charged in the case, isn't our world that we operate in. And following on from that, the revenue stream, I would argue, is very high quality because of that. Number one, it's professional. Number two, it's repeat referral work. So every single insolvency practitioner who's ever had a case financed by Manolete has always, without fail, over the 12 years we've been operating this business, has always come back to offer us new cases to purchase or fund. From that IPO in December 2018, with the key planks of the strategy, with the use of the IPO proceeds, was to take the business outside of its sole core in London and to set up a UK-wide in-house network of high-caliber insolvency litigators. So these were generally partners in insolvency law firms up and down the country, from Scotland all the way down to Southampton and everywhere in between, who'd worked on our cases. They knew us very well indeed. We knew them very well. And so they came on board very rapidly. And there you can see we've rolled out the regions very quickly. And we've only lost one person, which was a gentleman in the Midlands who had to retire very quickly due to ill health, and his replacement is coming on board in a few weeks' time. That team is led by Mina Halton, who is, I think, 60, 61 years old. She's been with Manolete for 7 years. Her entire professional life has been in insolvency litigation. The other person worth mentioning is Stephen Baster, who is on our board of directors. Now, Stephen was the most senior insolvency judge in the UK for 15 years before retiring in 2017. And on retirement, he joined Manolete as a consultant at the time, 2017. When Stephen learned that we were looking to list the business on the stock market, he approached me and asked if he could join the board. Now, that is worth pausing on that point, because an insolvency judge who spent 15 years looking at all the rogues gallery of directors and misfeasance that's gone on, for him to expose himself to any company as a statutory director really is saying something. So I think, as far as the due diligence box is concerned, I think the fact that Stephen asked to join the business, I think it's a plus in our favour. So the types of cases we do, again, I would say that this differentiates Manolete in a big way from lots of private and public pure litigation funders, in that it's the same 7 type of cases, we call them the 7 deadly sins, that repeat time and time again. And this is why I've got so much respect for the broader multinational-based funders, because one minute their investment committees are having to look at an intellectual property case under New York law, then a class action under maybe Australian law, and then maybe a personal matter under Russian law. And so that must be very, very difficult and challenging, and I tip my hat to them enormously. The world at Manolete is far, far simpler. It's the same 7 kind of cases, mostly under excellent legislation, which is the Insolvency Act 1986, and they're in that box there. So I thought I'd just trot through them very quickly. So preference claims, very simply, chap sets up a company, maybe his mother lends him £50,000 to get the company off the ground. Things go fine, then they don't go fine. 3 months before the company's going to go bust, you can see the writing on the wall, he gives his mother back the £50,000 that she lent the company. So he's preferred his own mother above the creditors. You've got to treat creditors completely equally. So the mother's either got to give back the money, or you can sue the director for misfeasance on that. Directors' loan recoveries are pretty standard. So many directors in millions of companies in the UK will pay themselves very, very low wages, because of course the tax take is the highest on payroll. So they'll take the minimum kind of 8,000, and they'll live their lifestyle through the business. And that could be holidays for the family, extensions to the home, children's education, what have you. We see it all. Now, in the good years, that's absolutely fine. Company declares a dividend and nets that off perfectly legally against the overdrawn loan account. The trouble is, once the company starts getting into trouble and then into liquidation, that is and the dividend isn't capable of being declared to net that off. That is a debt owed to the company and is repayable like any other debt. Misfeasance, direct negligence is really Companies Act, and it covers a whole load of misfeasance that can be taken against a director. For example, that preference example we used before. Unlawful dividends, again, links to the director's loan account. If the company did declare a dividend to wipe out that director's loan account, or to set off against some tax avoidance schemes, but it didn't have the distributable reserve to do that, that would be unlawful and strictly repayable back to the company. Breach of contract is where customers have not paid or suppliers have let the company down. Transactions under value is where the director, for example, might have set up a new co, seeing that the writing is on the wall, and transferred over a lot of machinery, property, order books over to the new co at an undervalue. And we see this an awful lot. So you can see there, we could either go misfeasance or TUV. Wrongful trading is when he should have thrown in the towel. You'll see there, because we'll come back to it in a few slides time, is only 4% of our cases. So he should have thrown in the towel. He becomes personally liable for the creditors, increase in the credit of the company if he doesn't. So these are all the kind of misfeasant actions, mainly by directors, sometimes companies on the other side. We had a case against the Cobham Group PLC, a big FTSE company, as was. So it's not always just individuals. And our thesis is that during these pandemic months and now nearly a year, as the quote there from the Times says, there will be eye-watering levels of fraud going on, I think to a level that even higher than it was going on before. So when you look at our returns on these cases, you'll see on the second column there, the number of investments was increasing very rapidly from 29 in 2018, doubling to 59, more than doubling to 141 in 2020. And then you'll see a good growth in 2021 up to January, but not the same rate of growth. And this is really what was behind that warning that we issued on the 26th of January, that that tremendous doubling of all Manolete's KPIs that everyone had seen over the past few years wasn't coming through now, and we'll go into why in a second. You'll see that very few cases are outstanding from even just a few years ago. So the ones we invested in 17, only one is left. This is the fifth column now, only 2 are left from 18. So very high and fast completion. So you can see in the yellow box is the first column in the yellow, how fast we complete these cases, an average of 11 months per case, which in the world of litigation is really super fast indeed. And then those IRRs that I mentioned before. So when I was growing up as an investment banking pod in the early 90s, the big kind of glamour job to go into was private equity. People were really massively attracted by the returns there, and they'd typically have 10 or 20 kind of large investments, probably bigger nowadays. But very typically the fund would seek an exit in about 5 to 7 years with an internal rate of return of 25 to 30%, which was looked at absolutely stellar. What you have with Manolete partners there on the right-hand side of the pink writing is we have 600 investments, so much more granular than the private equity model. The average duration of these cases is, as we said, 11 months, and then a further 12 months to the cash, again, on average. One has to, talking very generally here. And our IRRs, excluding those first 2 test years, 270%, which means on an annual basis, we're producing compound rates of return to that level. So the market opportunity for Manolete. So we deal mainly in corporate insolvency. You'll see in a minute some recent inquiries to us, and it is kind of 95% plus corporates. It also applies to bankruptcy. In normal years, putting COVID aside, there's 14 to 20,000 insolvencies a year. Lots of bankruptcies, but in 2020, and we'll get into this in a second, number of insolvencies was sharply lower, as we warned at the time of our half-one results in November. Professor Peter Walton has done 3 reports now, and he's saying that about 2,300 good insolvency cases see the light of day out of those 17,000 that go bust. So obviously an awful lot of cases don't even see the light of day, and about 750 million of cash recoveries eventually comes in on those cases. So Manolete, looking at its number of cases, that would give us a market share of just 6% of the 2,300, and that's based on March 20 numbers. If you brought that up to today, we're more like 9%, which is the kind of growth that one would expect. In revenue terms, we're only 4 or 5%, which means our average size of case still has some way to go to reach the industry norms. And Manolete is the 67% market leader in its segment. I must stress that, its segment of this market. Now that segment is only about 15% of that 750 million is done by third-party funders. So of that, Manolete is by far the dominant firm, 67% market share. The next closest is 5%, which is Harbour, which almost never does UK insolvency litigation. It does more international stuff, which we don't touch. So the rest of the market is all using this, the old model, as we call it, the no win, no fee and an adverse cost insurance policy. And as I'm sure many of you know, the Jackson reforms in 2016 made those highly unattractive. So no longer can the success fee and the OTE insurance policy be claimed out of on top of the damages. It has to come out of the damages. And as Jackson pointed out, those costs were 200% the size of the damages. So of course, this was not fit for purpose in insolvency litigation because the creditors would get nothing, of course. Whereas for Manolete, the cost of running our cases our way is just 10 to 12% of the damages. So really transformational returns to the creditors. Bear with me 1 second. So one has to ask the question, well, you know, why on earth do liquidators use no win, no fee, and AT even, you know, several years after the Jackson reforms? And I think these questions are being asked loud and clear now. So this is an article from January 2021, the all-party parliamentary group, talking about systemic issues in the corporate insolvency sector. There's no ombudsman, no mechanism for challenge, very perverse outcomes. We certainly see stuff which a layperson would say looks very wrong. So this is another one of those characters at the base of that Francis Bacon painting that we have to deal with and push that needle constantly to addressing as much of that 715 million market as we possibly can. And the reason why this is so important for the UK is that the World Bank rankings here come out every year, and the single biggest criterion is recoveries to creditors. Now, if these are all being swallowed up in insurance company premiums and lawyers' success fees, those are very, very low, of course, and that's why the UK, you will see there, is in 14th place behind Canada, Iceland, Puerto Rico, Slovenia, and Finland, to name but 4 or 5. And this is real money. This is creditors' money. Usually the biggest creditor, almost always there, is HMRC. And in these straitened times, these are our taxes. This is our NHS, as we hear every day, and these are our schools. And this is money not going back to HMRC, which is why we work so closely with them nowadays, as you would have seen on some of our cases. It's also the banks and the capital providers. And I think when you look at Brexit and the need to attract UK and external finance into our industries, there's got to be confidence to these financial providers that they will get a fair share of their money back should things go wrong. Pension funds, obviously, we've seen some very high-profile cases with Philip Green's companies, where that has been front page. And of course, there's a domino effect that if a company that's been denuded of its assets by directors on misfeasant actions, then the suppliers don't get paid, the customers don't get their rebates or their products or services, and therefore that could put those businesses into trouble as well. So again, with the impact of COVID and the economic consequences of that, this is very serious stuff. So the Royal United Services Institute think tank said that, that the fraud on the public purse had reached epidemic levels in recent years. So not just talking about COVID here. And the poor response from the authorities undermines the UK's critical financial infrastructure and reputation of the UK to do business. We would then argue, and this is why the FT headline below is helpful, that COVID and what the government's done has been like chucking a whole load of petrol on that bonfire of taxpayers' money. So what the government's tried to do, understandably, is to flatten the insolvency curve during these lockdowns, primarily to protect jobs. So we've heard of all these bounce back loads, furlough, VAT deferral, rent payment moratoria, the coronavirus interruption loans, and for the large companies, they've also had rushed through legislation in June last year, the SEGA Act, which the important bit for us with the temporary measures, so temporary suspension of statutory demands and winding up petitions. So when you look at what the government's doing, it's keeping these companies alive. So their business models are temporarily or quite possibly permanently broken, but they're paying for the ongoing costs. So their staff at 80% bounce back loans to fill a bit of a gap, but obviously the creditors who were creditors before all this are then frozen from collecting rent or rates or VAT or payroll taxes, etc. So you can see the government's almost put the economy in suspended animation for an extended period of time. And then, and this was very important for us in our corporate reporting timetable, with very little notice in December, the second lockdown was brought upon us, and those temporary measures were extended from the 31st of December until the 31st of March. We don't know if it stops there, and that's a really key highlight anyone must take away from this presentation. But this is costing the government an absolute fortune. These are the Office for National Statistics. As you can see there, the deficit this year was meant to be 55 billion. The latest projection is 394 billion pounds, 280 of it to fight COVID and its impact, and 73 billion for job support measures such as a furlough scheme. So we would argue at Manolete that at some stage this needs to come to an end, otherwise UK's problems are going to be bigger than just the insolvency stats ticking up. What will happen when these support measures come to a close? Well, lots of very worthy organisations have made some interesting predictions. The Federation for Small Businesses just a couple of weeks ago said 250,000 would shut up shop. Begbie's Red Flag report said 600,000 companies were on the brink. BBC reported up to 1 million. The London School for Economics, 900,000 businesses just a few weeks ago. Then RSM just literally a week ago said there'd be a spike in 2021. And interestingly, and part of my investment thesis ultimately is that this will be sustained for the next 2 or 3 years. So those numbers of hundreds and hundreds of thousands, maybe even 1 million companies, has to be looked at against the normal level of our addressable universe of 17,000 insolvencies. So even if all these authorities have got their numbers horribly wrong, it will still be a number a lot higher than 17,000, clearly. The big question for anyone involved in this space is how long will these economic support measures go on for? I see an image in my head of Manolete with a hose in a garden watering plants, with a constant stream of water coming out. And what Rishi Sunak has done is put his foot on that hose, not turning it off completely. We'll come on to those in a minute, but certainly the water coming out of the insolvency hose has been temporarily reduced. But what's happening behind Rishi, of course, will be an enormous bulge starting to form of the built up water that hasn't had an exit, and that's really the state of the UK economy at the moment. So all of this and the impact on Manolete, well, obviously there's the number of insolvencies turn into case inquiries. We tend to take about 30, nowadays actually it's closer to 35% of the cases we tend to invest into, usually buying, and that only takes 1 to 3 weeks to do. The smaller cases we decide actually within a couple of days. So the bigger ones take a longer time, of course, for good reason. Within a year, roughly speaking, generalizing, 90% success rate of completing the case. So we've taken it from a fair value as a new case onto and an unrealized gain into a realized profit once we've got a legally binding settlement agreement with the defendants. And then on average, it takes about a year to collect the cash. And again, very generalized here. Why does it take a year? Why don't people pay immediately? Well, some do. When you've got a big insurance company on the other side, we had quite an early case, actually £1 million settlement with 4 directors. They had D&O insurance, directors and officers liability insurance. We got all of the money in 3 weeks. There was a case that we announced at the stock market in November, December, £7.5 million. We got $2.5 million within a week, and the rest will come by December this year. So that's fast. But the slower cases, even on small claims, if you have settled with a director, let's say for £200,000, this transaction under value, unpaid director's loan account, whatever, he will probably have 30, 40, 50,000 pounds that he can get access to very quickly. He'll then need to refinance his home. He might need to sell various bits and pieces, jewelry, etc. So we put various restrictions on property, sometimes security as well, but we have a legally binding agreement. And if he doesn't pay that agreed payment plan within 21 days, he's served with the bankruptcy petition where he could lose all those assets. Of course, it's a fairly brutal world, but you can imagine some of the people that we have to deal with. And even some of the bigger cases, there was one that was absolutely extreme, that we settled for 15 million back, I think, in June last year, where HMRC, who were at the mediation with us, wanted the biggest number possible, but to get that, the directors had to agree to a 10-year annual payment plan on that. So you'll be seeing those numbers come through. But that, as I say, was a complete one-off and something that was taken rather out of context, but that's probably our fault on not communicating properly. So the impact on Manolete of the government measures, this was the graph and the statement we made on the 10th of November. So before lockdown 2, before the government extended those temporary measures until March. So as you can see in that graph, the top blue line is the inquiries in that funnel that were coming in this year. The red line is the previous year, and we were way above last year's numbers for many months into the lockdown. So April, May, June was huge. July, I think, was under highest number of cases, 26 that month. So every single business day of that month, we were signing a new insolvency case, which is fantastic. But then things changed. August, you never know with August, it's a funny month, could have holidays, but certainly by September, October, the alarm bells started to ring because we've never seen those lines come together. So the lead time between insolvencies and then us being contacted on them obviously would run out of air cover on that. So we highlighted that, and that's when I think firms like Miton, who listened very, very carefully to that, and Gervais clearly took the decision to start reducing his shareholding at that stage, as did Canaccord, from what we can see where we were sat. Then things moved really pretty rapidly and quite remarkably. So those support measures, as I say, were meant to end in December. They got extended with very little notice. But our December 2020 KPIs were actually very good. In fact, the whole insolvency market were very strong. We 45 case inquiries, which was good. We signed 14 new cases, which was way above the previous year, which was 9. So that was looking more encouraging. But then January, the KPIs started very slowly, and we had a board meeting on the 26th of January, looked at the Q4 reforecast, and although the business was still strongly profitable and in fact cash generation was at an all-time high, we weren't going to meet the forecast. So the advice from the Nomad was that afternoon we should immediately release an RNS to that effect. What was rather lost in that announcement was some very important factors. We'd completed 108 cases, which was double the number the previous year. Of the same period, the value of those settlements was £24 million, and that was including a big discount on that 15 million one that I mentioned earlier. So a very good spread across a number of cases. The cash receipts, which hopefully everyone's getting the message now. The cash you see in Manolete today is from cases that closed 2 years ago. There's a huge, big deferral cash build-up when you look at Manolete. It's almost like looking at the sun. When you look at the sun, you're looking at how the sun looked 8 minutes ago. When you look at Manolete's cash inflow, you're looking at the cash that was that's coming in now from cases completed 2 years ago. So even on that basis, the cash was up 60% to 9.3 million, much higher than the 5.8 the year before. Our retained element of that cash was 4.8 million, which meant that the net cash generated was 1.5, which was far higher than the break-even period the year before. So this build-up of cases and critical mass of cases and case values in Manolete was going exactly how we wanted it to go. And in that last quarter, so Q3, September to December 2020, we generated £5.3 million of cash coming into our bank account, which not only exceeded every single payment to insolvent estates and legal fees on closed cases, all the overheads, and also covered every single legal cost on the 250 live cases, none of which, of course, we were due to get any cash on for some considerable period of time. And that was sensational. So therefore,
hi Stephen, just a quick question. Yeah. We've probably got another 5 or so minutes.
Thanks
and then
very much indeed.
We'll probably head for Q&A. Okay.
Perfect. Thank you. So I'll summarize these things now. So I think on the key metrics, the business model was delivering exactly what we hoped it to achieve. The weakness was that the pipeline was being stalled, and therefore the unrealized profits and fair values, as you'll see on that slide, was the weak element of it. I've put this here. You can read it yourself at your leisure. It's just a snapshot. Obviously, I've taken out key names of the inquiries that came in literally in the last 2 weeks. I thought, let's lift the bonnet on the company so you can see the kind of granularity of what we see. We signed 10 new cases in the first 12 days of February. That's now 12 as I speak. So this is why I say that when Rishi Sunak stamped on my hose, he didn't turn off the water completely. We are still very busy. The 240 live cases and a decent level of inquiries, but just not the stratospheric rise that we had before. Our drawings from HSBC is no different at all to the 8 million we'd drawn at the previous March year end. So the accusations of Manolete hemorrhaging cash is patently false, and I'm being very polite there. Shareholder changes, and I should maybe just spend a minute on this, because I know there's some questions on this. So in amongst all that going on, I was approached completely out of the blue by some people from Mithaq Capital, who I recognise from the Burford shareholder list, of course. And they said they wanted to take a significant minority stake in Manolete. It would be passive, very, very long term, and they certainly wanted no board representation. And their ideal is to back founder managed businesses where the founder has got a big carried interest going forward. So to cut quite a few machinations short, they bought in a position. I don't know whether they directly bought off Soros, but certainly their position went dramatically down. Mithaq went dramatically up. Mithaq wanted a bigger stake than was available. John Moulton always refuses to sell any shares in Manolete. They practically had to break his legs to sell anything at IPO. So I reduced my shareholding from 18 to 16. It looked like I just sold those in the market. It was a very orchestrated event with Morgan Stanley and Mithaq, with a buy order for 1 million shares, and my brokers at Peel Hunt with the sell order, and the attempt was to match those in the market, which thankfully they did. There was a point there at the bottom on the HSBC RCF. I'm never allowed to go below 10%, which is absolutely fine. So really, I think the investment thesis is obvious. Is this temporary? My argument would be the government can't be running a deficit at that level for an even more extended period of time. Rishi Sunak stood up in the House of Commons in December and said we are reaching the start at the end of the pandemic, but the start of the economic emergency has only just begun. And he said the UK is to suffer the worst economic decline for 300 years. That is not a typo, it's exactly what the gentleman said. So although this is a morbid conclusion for the economy as a whole, of course it is, and will affect many people's lives, certainly for Manolete's business goals over a long period of time. Yes, we've been stalled at the minute, but I think over a period of 3 to 5 years, this has frankly underwritten our plans. With the share price where it is at the moment, I think it presents clearly a more attractive position for an entry point than was there even a few weeks ago on a business, as you can see in that box there, that's 3 times bigger than it was when it listed. That is it from me. I'm very thankful for your attention. I'm sorry this was such a long talk, but I was keen to just address a number of issues. Mike, back to you.
Just to remind everybody again that if you want to look at the questions and vote on any of them to put them towards the top of the list, I'll try and deal with the ones towards the top first, and we'll try and get through as many as we possibly can. Now, top of the list was the question as to why you sold a big shareholding, and I think you've pretty much answered that, although we may get some subsidiary questions as we talk through the rest. One of the other questions was that some shareholders were a little bit disappointed why the directors had bought in relatively small amounts shortly afterwards, I think, and some chat about whether this was just some kind of token gesture or what was going on.
Yeah.
I don't know whether you want to comment on that.
I'm very happy to make a comment. So just looking at those directors, so Stephen Baster, the judge, who I mentioned in my talk, that I think that's the 3rd occasion he's bought shares in the company. And again, given the quality of the individual we are talking about, I think one needs to look at that on a cumulative basis, and it wasn't to be sniffed at, the amount he put in. Lee Manning, a former senior director at Deloitte before he had to retire at the age of 60. Again, that was, I think, at least the 3rd time that Lee has invested in the shares. The newcomer to the share, Peter Bertram, sorry, our chairman, I think that was the 2nd time he'd invested, and again, at a decent level of investment. That I think where people have been, I agree with them, surprised was that the CFO bought only £1,000 worth of shares, which obviously is a low number. But you know, Mark's new to the company. He's a relatively young guy. He's got a young family. They're not a wealthy household, and I discussed it with the chairman at that level. Is it even worth even bothering? Because of the message it sends out, and Peter's view to me, and Peter's been around the block a lot more than me on this. He said, "Look, it's a start. I'm sure he'll follow up with further purchases." But I do recognise that didn't go down well. But I would ask people to look at it in the round of the other directors who are far more conversant with Manolete, particularly Stephen and Lee.
Right, thank you for that, Stephen. The second most popular one was to explain who Mythac Capital are in a bit more detail and why they've recently taken a sizable stake, and I think you've answered that one, but again, people can come back with subsidiaries, I'm sure, if they would like a bit more detail on that. Sure. Question here about the last interview you did, apparently with Proactive Investors. Goodness me, I didn't know you spent time with them, but never mind. You mentioned that you were paying a dividend due to the obligations you had as part of the IPO, and just a question, a concern that does that mean that there's an implication you could stop paying dividends in the near future, or? Yeah,
that's a very fair question. So when we listed, we said, and it's slightly convoluted, so we said that we would pay 20%, I think it was, of the previous year's post-tax profits as dividends. Mm-hmm. And the reason why we went forward with that policy at the time, we're going back to December 18, of course, is of those cornerstone investors who generously supported us, and I'm forever grateful. Premier Maiton Gervais, it was going into one of his key income funds, so it was very, very important for him. Now, with obviously Gervais's very profitable exit from Manolete, having bought in at 175, that obviously throws open the question as whether it's the appropriate thing to carry on paying dividends at that level. I can't prejudge the board debate on this, but what I would say to shareholders is it's an obvious item to be looked at this year.
Right, okay, thank you. There's a three-part question next, and the two parts of it you've already answered. I think it's the third one I'm not so sure about. What impact the COVID insurance Supreme Court judgment has on Manolete, given Manolete were quoted on Bloomberg stating how groundbreaking the verdict was.
Yeah, that was fantastic. Supreme Court, you know, with the FCA leading the test case. And it's very exciting for the insolvency practitioner community, because this is now another potential asset for creditors, of course, is claiming on the insurance, whereas the insurance industry was saying, we're not paying up, to put it very simply. Now, it's a lot more complicated than that. The devil is in the wording of every single policy, of course, so it's hard to generalize. This is very, very good news for the industry, but it's very early days. We've been approached by several groups of lawyers who are trying to aggregate, a bit like how we aggregated with the trucks, maybe taking a leaf out of our book there, they're trying to aggregate many hundreds of businesses, insolvent and solvent, to make kind of group type claims together. The big issue, and again, this is another look into one of those horrible creatures at the bottom of the insolvency crucifix, is the insurance industry. Is, of course, they're refusing to give any ATE out to any of these groups because, of course, these claims are against them. So they've been actually very threatening to the market. What's been very helpful for us is that we never use ATE. We always use much more interesting risk protection structures. So I'll leave it there because I don't want to give the competitors any edge before.
Right. Okay. Thank you. Now I'm intrigued. Question on just the mechanics of the profit warning that you put out here, because obviously most of these things normally go out before the market's open, and you chose, or your Nomad, it seems, advised you to put it out in the middle of the trading day.
Yes.
What was the thinking there? Because obviously it did create some turmoil around that. Obviously.
Look, I'm a former investment banker. I thought the right thing was you did it 7 o'clock in the morning, so everyone can get their heads around it and move on. However, the advice to the board was to do it immediately, and the words that ring in my head is that if you've decided at the board meeting you're going to do the profit warning at 1 o'clock in the afternoon, you've got a false market until trading stops. So don't shoot the messenger on this one. I was given the advice. We pay very royally for this advice. We followed the advice. I'm sorry if it scores people concentration.
Who is your Nomad, as a matter of interest? Sorry?
Peel Hunt.
Peel Hunt. Okay, thank you. Next question. Does this not mean that special measures will be extended to 2022? The government announced it intends to extend the power granted through the Corporate Governance and Insolvency Act to make temporary amendments, blah, blah, blah. The government laid the regulations on 11th of February 21 in Parliament ahead of the power expiring on the 30th of April. So they've given them themselves the power. It doesn't mean they're going to do it, though, does it?
Brilliant, Mike. So exactly, there was a sunset clause in the legislation that it ended in April, very sensibly. Things have changed. Lockdown 2's happened. No one knows with any certainty what's going to go on. So, as an administrative procedure, and I spoke to Lord Lee of Howard Lee, last night on this, because I thought it was a question. And I said, how would you summarize it? Do we see that as good, bad, indifferent? He said, it's administrative, Stephen. So his words, and I'm sure. So yeah, they've given themselves the option, rightly so, if it's needed. My personal view, and it's purely my personal view, is I think that if the vaccine's carrying on being as effective as they seem to be, is that as the schools come back and then you can do 2 families at the pub, etc., slowly they'll start to ease some of the economic support measures, the Treasury. But who knows? I haven't got a crystal ball. No one has.
Right. No, fair comment. I just maybe a subsidiary to that. But I'd be surprised if it happens. But let's say it did carry on that long, and the government was keeping alive a lot of zombie companies.
Yep. And
you saw the deal flow drop off to, or stay at, the kind of levels you're seeing in the last couple of months. What are the implications there in terms of the business? What would you have to do in Manolete to make sure that you survive through an extended period?
Sure. So stay at this level if we really have reached the bottom. And I think with the uptick in kind of right at the end of January to these first couple of weeks of February has been good. As I say, 12 cases. Let's say we end this month at kind of 14, 15 cases. That compares to 26 at our peak last year, which was the best ever at Manolete, 26, 28, etc. So that's still perfect. That's way higher than we were 2 years ago. So we've still got a humming business. What we haven't got is a business that's going to hit the very high stretches that Peel Hunt and Liberum were saying that we were going to make 14 million profit, 20 million profit. Obviously, that gets delayed. But certainly from a profit perspective, it's still very strong. From a cash perspective, I'd say we just become a very strong cash generation. As this last quarter, 5.3 million pounds came in because we're not investing in so many cases, of course,
Yeah.
and therefore we covered all the overheads, all the legal costs, even the legal costs in those 250 cases that have yet to deliver a penny in return back. So that's a great state for us to be in. So no worries on solvency in the slightest.
Okay, so yeah, there was a question. I've lost it now, but it popped up somewhere. It is on just looking at your IRR numbers that you quoted on one of your tables.
Yeah.
There was a question about what is that IRR net of the costs involved in the recovery of those funds and the prosecution of those cases, or is that a gross number, if you like, the versus the original cost?
Everything, net of every single penny.
Okay, thank you.
Yeah. There's no funnies in there, Mike, at all.
Okay. There's just a follow-up on the share sales.
Can I just add on to that, because there's some real sense behind that question. 98% of our cases settle as a consensual agreement with the directors. So we're going after them for £1 million, let's say. We sit in a room, now a virtual room. We agree a deal at, let's say, 600,000. We sign a settlement agreement with them. They pay, let's say, 100,000 within 21 days, and then the rest on the drip over the next 12 months, classically. Very different to us going all the way to trial, and then a judge saying, naughty director, you've got to pay £1 million plus everyone's costs. He's gonna, and this is why it's a great question, he's then gonna run and hide and possibly even go abroad. I've seen Burford and Therium struggle with exactly these issues, which is why they've got such big enforcement teams at these companies. With Manolete, 98% is a consensual settlement, so our enforcement is very strong indeed.
Okay, thank you. So yeah, I had a quick look at your numbers, but I can't say it. I got a good feel for it, but it looks like there's a sort of a steady run rate of cost there of circa 5-6 million a year, sort of
4.5 overheads, would you say?
Yes, if you like. Yeah.
Overheads.
Oh, it's about 4.5. Okay.
4.5. Yeah. And those are really flatlining.
Right. Okay.
That gives us capacity. So at the moment we've got 240 live cases. The infrastructure we've built up will comfortably take us to about 300, 330 live cases at any one time without adding anything to the cost base.
About 340, did you say?
Yeah, live cases.
Right. Okay.
300 to 330.
All right. Okay.
Yeah.
That's useful to know.
Yeah.
In fact, that follows on to one question here, which was how fixed is your cost base going forward? And will a large caseload inevitably require a lot more cost to manage them through to the settlement? It sounds like it wouldn't necessarily in overheads, but obviously you've got to buy the cases, so there's going to be a lot of cash spent up.
But that's, we say buy the cases, but we're only paying on average £10,000 upfront. So,
oh, really?
Yes. Yeah.
So even for a case of say $1 million or something, you're buying it for 10 grand.
10 grand. Yeah.
And are you seeing any competition to buy cases in that sense? In your sales pipeline?
We've had little bits of competition that's flickered for the last 5 years and then gone away very, very quickly. What they tend to get lumbered with is our rejected cases. We're so ubiquitous within the insolvency profession. The IPs tend to come to us first. If we reject the case, then that'll go to one of the kind of wannabe startup case acquirers. There's one firm in London called Henderson and Jones that's been going for about a good 3-4 years now. Two very nice guys, quite young, one lawyer from Freshfields, I think he was, one young IP from Deloitte. Look at their accounts in Companies House, micro company accounts, and they've just never got the traction and the build of the brand and the relationships and the UK network and now the PLC and the balance sheets, etc. So if you're an IP with a really good case that you're personally liable for, if it goes horribly wrong, and if your funder blows up and becomes insolvent, you're going to go with Manolete every time, not some new kid on the block, which is why I think it's been very difficult for any new startup to compete with this in this series.
Okay, thank you for that. I'm not familiar with how that system works. Just and if so, you could go to around 340 per annum in new cases, assuming that the situation, the market opportunity exists.
Yeah.
At what point do you think, in terms of case numbers and so on, assuming average sizes, would you need to go to the market for more funding, do you think?
So we think never at all. So we've run all sorts of scenarios, including the tsunami scenario in, let's say, 6 months' time or 3 months' time, whatever, because the cost of acquiring these cases is really very small. So you're absolutely right, Mike. Even at the £1 million level, it could be 10,000. It tends to start creeping up then, really juicy cases, 2, 3, 4 million, where the IP's been working on it with the solicitors for maybe 2 years before it's come to us, and they've got whip of maybe £100,000. We might be kicking in 50 grand, but we're on a profit share of 50-50 all the way up to, let's say, 2 million quid. And you see it in our returns that we control this very, very cleverly. So that's not the big spend. The spend would be, but again, it's not a big spend. Look at the overheads over the years, even with the big expansion in the UK network. Each lawyer in Manolete can handle at any one time about 25 to 35 cases. So you do the math on that. So we've got 11 at the moment, times 30 takes you to 330.
Yeah.
And so you just add more lawyers.
Okay. Thank you. Okay, just back to one or two here on the list. The top one of the list again is about the sale of your shares, and there was a question really about whether or not you're likely to sell more after the 3-month moratorium. But I think you emphasised on the slide that don't expect any action in that area.
We had to rush that bit, sadly. So yeah, but I'm very happy to say it. So just as we were getting the RNS out for my sale, Peel Hunt gave me a call and said, look, our legal people would like you to sign up to a hard lock-in for 3 months and a soft lock-in, i.e. you've got to go through them, for another 3 months. So of course, that's fine. And I'm very happy to go on record here. I have no intention of further sales in the foreseeable future.
Right, okay. Question here, is Rosenblatt gaining traction as a competitor?
Well, they had an update just last week, and I'm sure a lot of your members would have watched Nikki Fulston talking about that. So they set up Islero, which is the bull that killed Manolete. So that was really friendly of them. Yeah, and yeah, so they were asked by I always remember his handle, so Maddox, I think. Asked the question, David, I forget his surname, lovely gentleman, how many insolvency cases has Islero picked up since May last year? And the answer was 1. And then what Nikki explained was that their strategy has rather shifted. I think they're going to explain this in a few days' time. What it sounded like to me, but again, I might have this wrong and you should ask her, but it sounded like rather than insolvency, they'd really identified that the unserved market was actually the kind of Burford commercial litigation, but at the lower claim sizes than Burford. Burford really wants claims of 50 million, 100 million pounds, dollars. So it does leave a gap around that 5-10 million, and I think that's where Nikki's looking at there on the commercial litigation. That's how I understood it. I could be wrong.
All right, thank you. It's
but
interesting.
No, the ball has left the ring by the sounds of it.
Okay. The group appears dependent on just a handful of cases from previous presentations, the cartel cases with the undisclosed cases, plus a few others that seem to represent circa 50% of the reported net asset value. Can you outline the NAV concentration of, say, the 10 largest cases in your portfolio?
Oh, I see. Okay. So that question got better as he went along.
Yeah.
So what we do is every time we report, we break down. I think it was our biggest 17 cases in the presentations we do, and we do the what's a headline claim size, what do we think realistically is the claim size, what the costs are on that case. We don't name the case, obviously, that would be shooting ourselves in the foot. And the last time we did that, the two biggest ones were the 15 million settlement that we got and the 7.5 million settlement we got. So we knocked out the two biggest ones, way more. And the biggest one at 15, we were assuming a settlement of 5 million. So that's your conservatism and care that we put into these. So what's happening, Mike, is that as Manolete takes a bigger and bigger share of the bigger and bigger cases, what was a top 5 list becomes a top 10 list, becomes a top 17 list. The next one we'll do, it'll be a top 40 list. So to take the question, and it's an excellent question, is that concentration at the bigger end of the model is diluting every few months.
Okay, thank you. There's a subsidiary one here on this, going back to the selling of the shares again, about timing really, and why. You know, it was the share price was at a bit of a low. Could you have not persuaded Mithaq to wait a bit longer or something? Did you really need to sell? It must have been quite painful for yourself, knowing where the share price had been not that long ago, to sell them at that level.
Of course, and what's lovely to see is that the share price is now 15% up. I think it is from where I sold. It hardly dipped below that level, which is great. I saw Will Adderley sold a bunch of Dunelm. I love Dunelm. I'm a shareholder of Dunelm. But of course, the price came kind of flying down, and that's the typical thing. That didn't happen to Manolete. My judgment was we'd reached the bottom. Mithaq wanted a certain level of shareholding, at least, mark my words, and therefore to get them to that level, it had to be done. Now that took me from 18% to 16%. So if people think that changes one iota my spring out of bed at 6 o'clock in the morning, well, it doesn't.
It wasn't a pain for you to not. You could have waited until there were £3 again or something, I guess. Couldn't you? But,
Mithaq, you don't tell Mithaq to wait for however long. Yeah.
No, I can imagine.
And it was actually the message was very clear, Mike. Either they hit their investment requirements or they don't invest at all. That was very clear.
Yeah. Okay. Now I've got somebody's covering their bets here. They've submitted 7 questions in one block in order to get the votes up. So very crafty way of manipulating the Q&A voting system. I'll try and pick a couple of these that look as though we haven't covered them already. Given delays, what year do you think the truck cartel cases might settle? Currently on the balance sheet at 5 to 7 million, I think, ? And also, how many trucks are covered by the Manolete owned claims?
Yeah, okay, so there has been, and we said this at the interim stage, the one subgroup of cases, and they're very unique for us, are the cartel claims, call it Project Yorkie. There have been delays in the CAT, Competition Appeals Tribunal, because of COVID, which is frustrating. Our tactic on all of this has been to piggyback the far bigger claims of the Royal Mail. Therium are doing a fantastic job with the Road Haulage Association. Thousands and thousands of solvent companies going through, and there's many applications to court that costs, of course, £100,000 on both sides every time that at least that's done. So Manolete is keeping its powder dry, building up as much evidence on our claims, of course, as during that period. And so what we're hoping is that as we're ready to launch, which is probably about a year away from where we stand today, we'll be ready to issue the claim formally. We're hoping that by that stage, the others will be advanced and that either trials have been set, but everyone tells me these things never get to trial in the UK. See if they do or they don't. Saw Sainsbury's and MasterCard, that did go to trial. Or that settlements have started to come out, again, to quote the MasterCard thing, I think it was Tesco's, settled for 80 odd million quid, and that leaked out into the market. And so our strategy will be to take our 20 odd claims in these and yeah, see if they're interested in doing a deal, which is what we do.
Okay, thank you. There's a question here on the, you mentioned on one slide, page 24, it says here the 10 million bank claim.
Yes.
Is there anything more you can tell us about that?
Not at all. Not at all.
Okay.
Not at all. No,
okay.
No. And it could be one of many. If I printed out maybe 100 lines of our inquiries, there probably would have been 3 or 4 bank claims in there. I mean, we see them all the time.
Oh, you do? Okay, all right. And yeah. The subsidiary question to that was actually, do you foresee bank claims becoming a bigger percentage of your business in the next year or 2?
No, not relative to all these mis-selling claims, which was a very hot area for a lot of the time I've been running Manolete, the mis-selling of HBOS, Reading, the fraud that was being perpetrated there. So we've seen an awful lot of bank stuff in the past. We've had some great settlements against, I better not name them, but high street banks. And what they tend to do once they see us on board is come into the room very quickly because they know we'll go all the way if they don't.
Right.
So I welcome them, but I don't see them as necessarily a big growth area going forward.
Okay, thank you. One here on just picking up some wording in the January RNS, the board will continue to closely monitor the situation and its impact on anticipated levels and so on, and the naturally needed conservatism to be applied to fair values of ongoing cases, giving you some wiggle room, I guess, around how you proceed with fair values. And will the directors' fair value assumptions now, are they likely to be reduced in light of recent conditions, or?
We look at every single case, every single month with the lawyer on that case,
right.
with the CFO, with the head of legal. If we think that valuation needs to come down, it comes down. Because in our model, Mike, that case will be finished in a few months' time, and the truth will be known. So let's have the truth sooner rather than later. So I think it's just a statement to the bleeding obvious that any responsibility work, any director taking their responsibility seriously has got to do it accurately. And if that means down, it means down. And that's the nature of the game. This is litigation.
Yeah, so I understand that. You're looking at every case on its merits and taking a view. At the sort of macro level, do you expect that there's sort of a trend slightly downwards just because of the market conditions, and will there be factors that will make it more difficult to hit your targets as we go forward?
Well, I think that this is why I put it in the profit warning, is that it's a factor. I think the main thing is the volume of cases, which also includes, obviously we're not getting our fair share of juicy ones to replace the 15 million and the 7.5 million, which are now banked into realized profits. But of course, the profit on those cases was largely recognized in prior years, of course, because of this fair valuing that we have to do. So what you want to get the growth in profitability is the new 15 million, the new 7.5 million. And we're saying to people, we're not saying as many. And what we're not going to do, I had to rush the slide, sadly. There is a very important line there where I said, what we're not going to do in bold is start reducing our stringent criteria for care. I'd much rather keep our powder dry, our HSBC facility as full as it possibly can be for when, and I think it is when, not if, when this influx of cases does come through, then we can cherry pick to our heart's content.
Right, thank you, Stephen. Look, it's 6:15. There's still a few questions dribbling in, but I think we've covered most of the ground actually, just glancing down the list. So I think we should call it quits at that point. I'm noticing there's a drop off in attendees now, so I think we've exhausted everybody's stamina, but I think you've covered a hell of a lot of ground, and I'd appreciate the fact that you've stuck around for another 15 minutes to,
absolute pleasure, Mike,
to answer as many questions as possible. And thank you very much. You've gone into an awful lot of detail, and you know, personally I'll be going back through the pack as well and just refreshing my memory on some of those things. So thanks for being so candid with us and helpful today. And maybe,
well, a real pleasure, Mike, and thanks to you and Amanda, of course, for putting it all together. Really very grateful.
Right, thank you for that, and well, hope to see you again in the not too distant future when some more news emerges, maybe.
Indeed.
All right.
Lovely.
Thanks,
Mike. Thanks, everyone.
Yep. Bye for now. Okay, thank you everybody who's still on the line. Just very quickly before everybody disappears, do remember that there will be a copy of the presentation and a recording on our website. Please do fill out the feedback forms and tell us what you think. And there's a list there of the up and coming webinars that we have in the list at the moment, all on our website where you can see more information. I think also, Amanda, we do have an after meeting today that will cover off this presentation, and you can talk about Manolete in more detail. And I'm hoping that the actual link to that, Amanda, will be posting in the chat box shortly if you haven't already got it, so that you can see it there. And I wish you well in your investing in these interesting times, and I look forward to seeing you maybe next week for Sensign Health or one of our other events shortly. So thank you very much for your time this evening. We'll leave the screen open for a while so that you can get into the chat box and get the link through to our Signet after meeting if you want to join your fellow investors and talk a bit more about Manolete. Meanwhile, good night from me.